Hey guys, Brad Flynn here, and today we're going to look at your profit and loss statement from the view of depreciation, which can be a little bit confusing for some people. So we're going to sort that out for you today. So let's assume in our business, we decide we're going to buy this funky looking big tractor. Maybe we're an earth mover, maybe we're a builder or something like that. We're going to buy this big machine thing, right? And let's say this big machine thing costs $100,000, okay? Now, here's how it will flow through your financial statement. So first of all, let's assume we've got $200,000 already on our balance sheet sitting in our bank account somewhere, okay? Now we've just bought this $100,000 tractor. What's going to happen is your property, plant and equipment will go up by $100,000 and our bank balance will go down by $100,000. So it will go from here to here, okay? Nothing happens on the P&L yet, okay? Any capital purchase like this sits on the balance sheet. Now it goes to the P&L when we're going to do our tax and so forth. This is where depreciation kicks in. So what governments allow us to do is to write down the value of our equipment over time. So in this instance, when we start, our tractor's worth $100,000 and governments have lists of what you can and can't do. So let's say we're going to depreciate this by $30,000 over 3.3 years or whatever the number is. So the way this works, watch this. The value on our balance sheet, if it's $30,000 in our first year, we're doing our tax, will now go down to $70,000. Now where that will come out is we'll get a depreciation that will flow through that we can add to our P&L. Now let's have a look at the P&L for this business. And I've called it an income statement, same thing. P&L, it's the same thing. So let's say this business has income 500, cost of goods 300, so our GP is 200. Our fixed expenses are 100, so 200 minus 100 gives us 100,000 profit. And let's say we're paying 30 cents in the dollar tax. So in this instance, we're going to pay 30% of 100,000 is $30,000. Now, this is where depreciation is one of our best friends. Let's rewrite the P&L this way. So we're still going to have our 500,000 in income. We're still going to have our 300,000 in COGS, and we're still going to have our 200,000 in GP. Now what happens is we add our depreciation to our fixed expense, even though it's nothing physical. Profit and loss is all about theory, it's not real. So now we've got $130,000 in fixed expenses because we've taken this $30,000 from our assets and written it off to our P&L. Now we have $70,000 in profit. Now here's the cool bit. Quite often when your accountants are doing this, they will try and get your profit down below a tax threshold because let's say in this instance, they only charge 20 cents or 20% in the dollar for tax for profit that's below, say, $72,000. So now we only pay $14,000 in tax. So everything else is the same, but our profit now shows us with the depreciation lower and we pay less tax. So hopefully that helps, makes a bit of sense to you. Thanks for watching. Any questions or comments, put down below. Make